So Meta just brought in about $61 billion in revenue this quarter, but somehow an absolute tidal wave of server spending completely vaporized their free cash flow. Welcome to Earnings Unscripted. It's July 29th, 2026, and we're breaking down Q2 for Meta, ticker META. So top line's up 28% year over year, which sounds amazing, but then you actually look under the hood.
Right. Under the hood, it's quite jarring. You see that top-line growth and expect a total cash printer, but they took an absolute hatchet to their free cash.
Okay, wait, just so I'm processing this. The core ad business is clearly humming, but the actual cash they retained dropped all the way down to about $784 million. Are their operating costs really inflating that badly right now?
No, that's the illusion. Their operating income actually took a small hit because of a legal charge and some severance, but the real cash drain is strictly capital expenditures. They went on this absolute infrastructure binge, spending $31 billion on physical servers and data centers in a single quarter. It basically cannibalized all the cash the ad engine generated.
Which obviously spooked the market. Earnings landed at $6.18 a share, down noticeably from last year, and the stock just gapped down hard in the extended session, completely wiping out their recent pre-earnings momentum. And just to keep the lawyers happy, please remember these are strictly our own opinions and not formal financial advice, so don't rework your retirement plan based on our shock over a server bill.
I think the heavy selling makes complete sense, though. Wall Street's historically valued Meta as a high-margin software business, not a heavy industry construction firm. Now they're buying compute capacity like a utility company buys coal.
Yeah, Mark Zuckerberg literally cited the World Cup final on the call, noting the unimaginable volume of real-time messages WhatsApp was processing per second. It just proves how intensely heavy their global infrastructure needs are today.
Sure, the compute demand is real, but the financial mechanics of how they're paying for all this hardware are getting really strange.
Right, which brings me to the weirdest part of the cash flow statement. I noticed they completely halted their Class A share buybacks for the first half of the year, and instead they just swallowed a massive pile of new long-term debt. I need to know why they're suddenly borrowing money like that.
Because they need the capital runway, plain and simple. They brought in roughly $25 billion in net proceeds from debt markets to keep feeding the server machine. That pushes their long-term debt past $83 billion. And you're right, they spent exactly zero on share repurchases in the first half of the year. Susan Lee was incredibly direct about the strategy shift. She said, and I quote, "We have generally found it prudent to continue adding cost-efficient, long-duration sources of capital as we make investments in initiatives that themselves have long time horizons, especially AI infrastructure projects."
Okay, wait, just so I'm processing the mechanics here, the classic Meta playbook is they print ad money and then they buy back their own stock to reward shareholders. But now they're saying they'd rather sit on that cash, take on debt, and just buy mountains of hardware so they can run their own internal AI models, like the Muse Spark things they mentioned.
No, but that's exactly the twist. It's not just for their own internal models anymore. I mean, obviously they're doing that, but Zuckerberg dropped a major hint that they're effectively becoming a vendor. He said they're getting, quote, "a lot of offers for compute at a significant premium over what we paid for it."
So they're literally renting out their servers. Are they just accidentally becoming a cloud provider like AWS?
Pretty much. Look, the whole industry underbuilt for this AI wave. Meta bought up a massive chunk of the global GPU supply early, and now they're realizing they can just lease it out. It's basically a hedge. If they sell compute to third parties, it subsidizes their own massive research costs.
That's actually wild. It totally recontextualized that BlackRock thing. I saw they're partnering on a new data center down in El Paso. If they're trying to act like a utility, doing an off-balance sheet joint venture makes perfect sense.
Yeah, and it's a 1 gigawatt facility, which is basically a small nuclear reactor's worth of power. Doing it as a joint venture keeps the construction costs from completely nuking their direct P&L, but the physical ambition is just staggering. Zuckerberg flat out said, quote, "It just seems to me pretty clear that having kind of sovereignty over building your own models is going to be an important part of that stack going forward."
Right. Sovereignty. It's such a violent pivot. We're so used to them as a social app selling optimized ad space, and now they're pouring concrete in Texas and hoarding power. Are they getting totally distracted from the core business?
I don't think so, actually. The core stuff is quietly adopting all this AI heavy lifting, too. They shared this anecdote about Movida, a massive car rental fleet down in Brazil. They integrated Meta's business agent into their WhatsApp platform.
Like a basic automated customer service bot?
Much more than a basic bot. It handled the entire flow: vehicle selection, pricing, payment. 85% of all their WhatsApp inquiries were resolved with zero human intervention, and daily bookings jumped 44% over the year. So the enterprise utility is definitely paying off in the real world.
Wow. Okay. So it's a fully operational booking engine now, not just messaging. That completely explains why their non-ad app revenue finally crossed the $1 billion mark. I guess the real question is just how long Wall Street tolerates them financing all this global infrastructure on their own balance sheet before those returns have to show up in the margins.
Wall Street tolerates it exactly as long as the core ad business keeps firing. If that advertising engine ever stalls, the patience evaporates instantly. But right now, management thinks the real risk is actually moving too slowly, not too fast. Susan Lee basically said they're expecting to be demand-constrained for the foreseeable future.
Which completely explains their guidance. They actually raised the full-year expense outlook to somewhere between $165 and $169 billion, and that includes absorbing that massive legal hit they took this quarter.
Yeah, and they pushed the capital expenditure target upward to a midpoint of about $137 billion for the year. It's just a relentless pace, but they can justify it because they expect third quarter revenue to land somewhere between $61 and $64 billion, even with a slight currency headwind. As long as the top line delivers, the heavy industry build-out continues.
I just wonder if the non-infrastructure risks are being ignored right now. The CFO specifically warned that ongoing scrutiny around youth-related issues could ultimately result in a material loss. If multi-billion-dollar legal judgments become just a normalized operating cost, that balance sheet might actually feel the strain.
Right, especially when they're already issuing so much debt just to keep the AI lights on. The margin for error is shrinking. They're executing brilliantly, but they're running the financial engine at the absolute red line.
We'll have to see if they finally tap the brakes next quarter or just keep accelerating. But that's our take on Meta for today. Thanks for making sense of the madness with me, Miro.
Anytime. Catch you next time.
If you're enjoying these quick dives, you might want to keep this show in your regular rotation. This entire episode, including both of our voices, is a fully synthetic AI experiment. And that's how we're able to turn Meta's server bill into audio on the very same day. We'd love to know what companies you're watching, so please drop your ticker requests at earningsunscripted@datamadness.ca.
Talk to you soon.